Hello viewers, in this video we'll be going over the S&P 500 and we'll go over the WTI crude oil. Right now we'll examine the S&P 500, and this video will be going over the day-by-day probability model, how we find the models, and the forecast model for the S&P 500. So back to technical analysis. The S&P 500 is currently down 1.8%, and on the 1 hour chart we just got off of oversold RSI, and as for the 4-hour chart, we are currently oversold on the 4-hour chart. There's some concern. We have not made any attempt to make a convergence on the 4-hour MACD. As we expand that to the daily chart, it is quite an impressive drop, especially in 1 week. We're currently oversold on the RSI and the daily MACD. Again, since we have this wide gap in between the divergence and convergence, there's no reason that we'll see a sharp reversal. So it will take time for this damage to recover. So if we do manage to continue to fall, I do see the next support being where we left off back in last year. We made 2 support levels around August 6th and in October 3rd, and we're fairly close to that level, which is around the price of $283.25, and we're a few percentage away from that level. And as for resistance, if we do manage to make a reversal and head up higher, the next resistance that I see will be the 200-day moving average. It's quite unlikely we'll see a V-shape immediately. It may take some time, so we'll see sideways price action and we'll gradually hit that 200 moving average. And that resistance level is around 304. And if we were to head up higher, make a reversal, that price movement is roughly around 4% to the upside. And if we do manage to move down lower, that price movement is roughly around 3% lower as well, or 3% to the downside to hit support level. So back to the day-by-day probability model. As the days progress to the 7th day, we have a 29% chance for the S&P 500 to climb higher between 0 to 2%, and on the extreme case, we have a 14% chance for the S&P 500 to climb higher between 2% and 4%, a 14% chance. On the other hand, we have a 14% chance for the S&P 500 to decrease between 0 and negative 2%. And on the extreme case, we have a 42% for the S&P 500 to continue to fall lower between 2% down and 4% down. So again, this model is now available in the link below, so do check it out. So let's go over where the S&P 500 will head to next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below it is the trend that I believe is the best match. This trend dates back to October 28th, 2009 to January 26, 2010. So let me point out why these 2 charts are similar. So what we have here in the current trend, we start off at the middle Bollinger Band, and then we proceeded to average above the middle Bollinger Band for several weeks. So we see that price action there. And next we take a slight dip near the middle Bollinger Band once more, average again above the middle Bollinger Band, and then finally we see the reversal where we currently are at now, touching the bottom Bollinger Band. So we have those points there, and we start to see a similar pattern here as well. We start off at the middle Bollinger Band, and after starting middle Bollinger Band, we average above the middle Bollinger Band once more, and then next we take another slight dip below the middle Bollinger Band, and finally our last average above the middle Bollinger Band in this trend, and then we see a similar dip in the current trend here as well. So what we have is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are the same. The outcome and the forecast should be fairly the same. So the model that we just examined was October 28th, 2009 to January 21st or 26, January 26, 2010. Back then, the S&P 500 continued to dip between around 2.8%. So if we head back to the day-by-day probability model, it coincides with this standard deviation of 2% drop with a 43% chance. Again, this model is now available in the link below. And let's review WTI crude oil. So what we have here, WTI crude oil is down around 4.8%. And if we examine the 1 hour chart, we're near oversold RSI as well. On the 4 hour chart, currently oversold at the RSI, very close in correlation with the overall market, and also oversold on the RSI. And as for the MACD, we saw a divergence after seeing a convergence back in February 12th, which is a concern that the reversal in WTI crude oil was abruptly interrupted, and now we continue to see a downtrend in oil itself. So if we expand out, the next resistance, or I should say support level, was seen back in December 24th, December 24th, 2018. And let's mark that as our immediate support if we do manage to fall lower. And that is around a price of $42.64. And if we do manage to make a reversal and head up higher, the next resistance that I see is where we made an attempt at a support back in February 4th around a price of $49.40. So let's expand that a little bit. And if we were to head up higher to that resistance level, that price movement is roughly around 10% to the upside. However, if we do continue this downtrend, that price movement is around 4.5% to the next support level. So let's head to the day-by-day probability model for WTI crude oil. So what we have here as the days progress, we have a 42% chance for WTI crude oil to climb between 0 to 4%, 8% for WTI crude oil to climb between 4% and 8%, and also a 33% for WTI crude oil to fall between 0 and -4%. And on the extreme side, we see a 17% chance for WTI crude oil to fall between -4% and -8%. So we'll examine the day-by-day forecast for WTI crude oil. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, averaging above the middle Bollinger Band. Next, we proceeded to continue to slope down, touching the bottom Bollinger Band. Let's just mark all the instances where we touch the bottom Bollinger Band. So we have 2 there, and we have an attempt to revert back to the mean right here. So we have those points there. Let's examine the trend in question. We average above the middle Bollinger Band as well. Next, we proceeded to touch the bottom Bollinger Band, and next revert back to the mean where we see the middle Bollinger Band, and finally we touch the bottom Bollinger Band once more right towards the very end. So we have those points there. what we have is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So again, there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was March 25th, 2011 to June 21st, 2011. Back then, WTI crude oil was up around 1%. So it's up 1%, not a complete reversal. So we might see sideways price action in play. And that 1% up coincides with this standard deviation with a 42% chance, among the highest in the standard deviation tables. So again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.